And Bill asked earlier today, I've got a married put position on BERY, where the stock has fallen 9% since his original purchase price. It appears to be having a bit of support at the 200-day MA, but I'm not sure that is going to hold. The position analysis tool, as we're tracking a position in the portfolio, we link to a position analysis tool to see potential rollout opportunities and adjustments, is showing him a potential income method to lower the strike on the put. But Bill's afraid, of course, that he doesn't want to chase the stock to the bottom if it's going to be a loser. All right, well, let's go ahead and pause the screen and let's switch over to PowerOptions. And what we're going to do is take a look at this in the portfolio tools. There we go. I'm going to take a look at this in the portfolio tools to see the rollout opportunities that are suggested. We're going to talk about one of the 12 different income methods that he's seeing that's discussed in the blueprint. Of course, to start from scratch, the married put position is a limited risk trading concept. We're going to buy shares of stock and buy a put option following the 3 core principles discussed in our preferred work, the full outline of the strategy called the blueprint. Using that proper structure, we limit risks to single digits while leaving the upside open. Of course, when we enter the trade, we're expecting the stock to go up. This is a bullish strategy. Sometimes the stock will stagnate, and sometimes the stock will fall after we enter the position. But there are adjustments that can be used in any of those situations in the blueprint. That's why there's 12 different income methods. And we're going to take a look at this one to the downside. Let's go to the portfolios. And in the portfolios view, under the My Portfolio tab is where we track our open positions. I've entered essentially Bill's position as he sent it to me, excuse me. So Berry Plastics, BERY, don't know the trade date, that's okay, but he's got a cost basis of $54.17. And he bought the June 60 put following the rules in the blueprint for $8.42. Now, the stock, as he mentioned, has fallen 8.9%, down to $49.37. The put has increased in price as well, countering some of that loss on the stock. So right now, let me move this over here. As you can see, the whole position is down only 152 or 2.4% based on the closing prices and the midpoint price for this particular put on BERY. Now, first things first, let's just take a look at the chart. And here we see what has happened. We don't know, again, when he exactly got into the position, but we see what's happened, of course, the last few weeks here on BERY. Stock was trading right around where he wanted, moved up to about the $57 range, and then it started to drastically pull back at 55, and then it just started to fall. That's not drastic, I'm sorry, it's only about 2 or 3 points there, but then it started to fall, and here we are down in this point. Everything about this stock now sort of still points to a bearish position. We have a declining MACD that hasn't really settled yet. We're trading down and descending, I should say, the lower Bollinger Band. We're below the 20-day moving average. Now, he had mentioned the 200-day, but let's go back real quick here. Let's just take a look at a 6-month chart, change it from 3 months to 6 months, and you see what we might consider some areas of support around this line, around 46 perhaps as well. So Bill's concern is doing an income method now if the stock continues to fall. The particular income method that we're talking about is essentially a great means in this strategy to average down as you would if you were just holding the stock position. But instead of putting more capital into the position, because we have the proper structure to begin with, we can average down and lower our cost basis instead of adding more capital into the position. So lowering our cost basis by taking a credit by manipulating the put option, our second working asset that is going in our favor. Okay. All right. So what is he talking about in relation to this rollout opportunity that he's seen? Well, if we go to that Edit More Information button, as I'm tracking any position in the portfolio, we'll go to Position Actions and then Position Analysis. Now we know the original position. We own 100 shares of stock at $54.17, bought the June 60 put for $8.42. Total cost basis into the position is 62.59. Is that the break even? Well, it's the break even, yes, but the break even only at expiration. If Bill ends up holding this position all the way to June, makes no adjustments, accepts no dividends if Barry pays a dividend, then yes, at June expiration, need the stock to be trading at 62.59 to break even. You see here, though, at the halfway point, we'd see a small profit on the position if the stock was only trading at 55, just a small price from where he originally purchased the stock, because the put will still contain time value. But as we can see, the stock's down to 49.37, that 8.7, 8.9% decline from when he got into the position. And if we scroll down here, we see our current liquidation value that we saw back in the portfolio of 2.4%, nor the 25 days. I just selected a time, a trading date there. And again, the max risk is 4.1% at expiration. If the stock stays at 49.37, in the next 140 days, we make no further adjustments to this position. Now we scroll down further and we see some rollout opportunities where the math is done for us, and we see we can adjust the put to lower strike prices, and that averages down the break even. Let's take a look there. So here is our break even column. Remember, our original price was 62.59. We roll down to, say, the June 55 put. Might want to go a little bit further than that depending on the situation. But in this case, we'd lower the cost basis down to 58.47. We're going to sell our put for 11.70, buy the lower strike put for 8. We essentially lower it by $3.70. But we are increasing the risk. Because remember, we're holding that 60 put. We're getting $3.70 of credit, essentially, as we're selling this for $11.70 and buying this for $8. Remember, the original price of the put is already taken place, is already accounted for, excuse me. So this is going to lower our cost by $3.70, but we're agreeing to give up the shares at 5 points lower. That is why the risk increases, because the difference in strike prices is greater than the net credit we're receiving. But what would this do? If our expectation is that we are at the bottom and the stock is going to recover in this situation, this would be able to allow us to take more advantage of the increase in the stock price with a lower cost basis of the position and still single-digit risk in place. With the stock at 49, though, 49.50, 49.35, might be tempted to go lower here to the June 52.5, which almost doubles the risk in this case, but it takes the cost basis down to 57.14. So about another $1.60 down to lower the cost basis in price to keep the risk still in single digits, but on more of the high side risk of that equation. So we're not going to go into any more details than that, because the full details of why we'd use income method 9 we touched upon, but that's really described in the blueprint there. But Bill, you've answered your question in a sense already. You have 3 choices right now looking at this position. Of course, let's go ahead and go. Yeah, I'll go to the 52.5 for now. We're going to simulate trade so we can see that side-by-side comparison of where we are now and what our new position would look like with the higher risk, but with the lower cost basis on the position. Why would you choose to do this right now, Bill? Well, as you said, you really only want to do this if you think the stock has finally bottomed and you think it's going to start coming back up in price. If you think it's going to continue to decline, what we're sort of discussing here is what's called the SIGA model, which is discussed in the blueprint for all 12 income methods. It's really our decision-making process. It stands for, of course, what are the current conditions in the market? What are our expectations going forward? What are our goals for the trade? And that determines our action. So, current conditions are the stock's down 9%. Bill's afraid that he doesn't want to watch it continue to move down, because he's afraid that if he increases the risk, he may take a higher loss on the position and it's not hit the bottom. And as I mentioned, the rules, guidelines for doing this is if you think the stock has hit the bottom, you may consider rolling down this put option because you're expected to see a turn. If you think it's going to continue to decline, you might want to consider evaluating a 9, but maybe combined with an income method number 12 on that position, Bill. Or you may want to consider just exiting the position and getting around that 2.4% loss only, and look for a new stock that is matching a better trend for this particular strategy that matches your goals and your expectations. I guess Ernie's thoughts on this would be very similar, but if you like the stock, but you just think it's weak right now, and it may continue to go down, then you might want to wait a little bit, wait another week, another 2 weeks, see how it plays out, and then, of course, decide if that's the right time to roll down the put there and try to lower the break even. And then, of course, we can still use the other income methods as the stock starts to recover. So quick review again. 1, use it if you think you've hit the bottom. 2, exit now out of the position, take that small loss, and look for another trade that you feel matches the sentiment for this, or that's matching your movement that you expect for the married put structure. Number 3, wait on the position. Of course, if you think that it hasn't hit the bottom yet, but it may soon, within the next 2 weeks, maybe 3 weeks, and then you can look to adjust the position. Number 4, of course, I mentioned if you think it's going to continue to move down significantly, I mean more than 2 points, okay, more than to maybe even 3 points down to 46.50 or so. In this case, if you think it's going to continue to fall, you might want to consider a 12 or another adjustment on this position that would leave that downside open on the trade if your new sentiment is bearish on the position. You don't still want to try to repair the bullish structure if your sentiment has completely changed. And Bill, I don't get the sentiment that yours has on this position, simply because you said that you don't think it's hit the bottom yet. You're worried that it might continue to fall, but you're still staying in the trade, which means you still think it has upside potential, profitability going forward in that case. So that's why you're still in the position. Okay. And this idea of maybe a 12 or 9 and 12 combination is only if you think the stock's going to fall significantly further. I'd say down in this range, $42, $43 or lower. All right. So that's where we kind of stand right now. Some thoughts on the BERY position, when to use income method number 9, as I mentioned, but more discussion on that, of course, is available in the blueprint for all 12 of the income methods that we discuss in that case. Speaking of earnings, I apologize. One thing I did not mention, for Bill, of course, is you've got the June put. Here's another thing to keep in mind. You've got earnings coming up. I forgot to check this earlier, but you have earnings coming up on 2/5. That's confirmed, and it's going to be before the market, Bill. So depending on what your outlook is for the stock position, naturally, I wouldn't do any income methods now to hedge the loss that would cap the upside with the earnings coming out next week. Yeah, math is correct, next week. And of course, you may not want to increase the risk right now before the earnings event. Now, why do I say that? Well, if you get a good move that you're expecting, if you get, let's say, a 7-10% move on this stock, roughly up about $5, that'll put you back at where you started, about 54. And you're still holding that 60 put. So with that movement, you could still generate some income using the 60 calls or other income methods, I think, with the stock moving back up to 54, even though you're holding that 60 strike put. Now, if it falls the other direction and it falls another 4 points, it goes down to 45, goes down to 44, down to the range I was mentioning, well, now you have a better gauge of the weakness or strength of the stock. And you still might be able to get out with only a 3.5% loss. I'm sorry, your max was 4. So you might get out with a 3% loss in that case, instead of the full 4% loss if the earnings disappoint and you don't expect it to recover after that point because of the decline. So I apologize there, Bill. That's something else that you want to consider when you're thinking about doing some of the adjustments that are shown to you. What's coming up in the next 10 days, under 10 days, the next 6 days or so, 7 days, there on February 5th for the earnings of BERY. If you do the adjustment beforehand and the stock falls, you might have increased your risk to the downside. And if you do it beforehand and the stock moves up, based on the earnings that we're talking about, you would have lowered the risk on the position and you could be closer to break even now. You might even be able to do more income methods if you'd lowered the put to the 55 or to the 52.5. But is it worth it to double the risk to 8% to lower the put now, planning and hoping on a positive earnings if we're wrong and the stock drops? And now you're looking at a 6% risk instead of a 2.5 or 3% risk as well. Okay? So that's what we're looking for in those scenarios. That's the other thing I forgot to mention in my initial discussion. Just remember to look at it because as I put it together today in your portfolio, that's what I was looking at as well. I'm in a similar situation, by the way, with the DAR married put trade and actually RBA. And every time I think about doing income method number 9, for example, when the stock was at, let's just take a look at the chart. And I am going to do income method number 9, but I'm waiting for what I feel. I'm getting psyched out. And I gave this one time to play a week or two ago. I believe it was 2 weeks ago. We had done a review at the beginning of January of the 4 married put positions we had open at the time. And RBA, of course, was one of them. And this is what the stock was doing. And I said, well, I'm planning on doing an income method number 9, but I don't want to get trapped. Meaning I was thinking about doing it here and it continued down. And then I was thinking about doing it here and then it pulled down again. So I'm hesitating. And when I started to come up, I was really considering it here. And I believe I'm in the 70 strike put on RBA. And I was going to come down to the 65 when it was here. And I was thinking about maybe even doing the 65 when it was here, but it was very high time value, the at the money bell curve. And I didn't. And then the stock faked me out again due to the weakness we've seen in the last 3 days across the broad markets, not on some of these other things that we're talking about here. So now there's a choice that I may be able to even consider going down to the 60, but the risk is going to be increased a lot. So what I'm evaluating now is exactly what I told you. I've been faked out on this because I thought this was the bottom and it proved me wrong. So now I'm waiting and we see another bottom here again. We see another continuation down. It's like you said, it's sort of along the same line going back. So if the market starts to open good on Monday, maybe even Monday to Tuesday, I'm probably going down to the 65 strike here on this position with that income method number 9. Earnings aren't as close as yours, Bill, for that February 5th discussion in your situation on Berry, Bery. It's a little bit further out, but it's still coming up in February, so it's not too far away as well.